Mutual funds for the rest of us. So in my previous video, I talked about what a mutual fund was, which is simply a bag of stuff. Now, I want to talk about the different, what they call share classes for the mutual funds. So, for example, when you look at a mutual fund, you'll see, say, a large cap growth, share class A, share class B, share class C. Well, what does that mean, and which one's right for you? Well, the interesting thing is that even though they have those letters after it, it's basically all the same grouping of stuff. So it's all the same bag of companies. That doesn't change, but it's just really how you pay for it. So in the previous video, I gave the example about, you have your shopping cart, you bring it up to the cashier, she bags it, you're ready to pay, and now the question is, well, do you want to pay by cash? Do you want to pay by credit card? Do you want to pay by debit card? Do you want to pay by check? It's very similar to that. But well, let me actually just start explaining. First, I'll just do a very, very brief explanation of each one, and then I'll get into a little bit more detail. So, for example, your A share, okay? So, again, this example, large cap growth, A share. So the A basically means, and I'm just going to use just average terms that you and I can understand. Basically means you're paying your commission up front, okay? So in an example, let's say you're rolling over, that's a term that they use in the industry. Let's say that you have a 401k or a 403b, which is basically your retirement plan at a previous employer. And you bring that over to an IRA. The term for that is rolling it over. So you bring that over to an IRA. Let's say you have $100,000, okay? So whoever you're talking to, if you're working with an advisor, they'll say, okay, well, you can buy what we call an A share. And that means basically that you bring $100,000 over and you're going to pay a commission up front. Okay. A B share, there's no commission up front, but there's like a commission that you have to pay if you sell it too quick. So usually you have to sell a B share for about 6 years or so. Could be a little bit more, could be a little bit less, but let's just say about 6 years. So you have to hold it. If you have to sell it, say something unexpected happens and you need to sell that early, now they hit you with the big sales charge, okay? So that's the B share. The C share, there's no commission up front. And again, they use different words, but this is just words that you and I understand. There's no commission up front, but there's higher management fees, or there's higher costs, or there's more of a commission to manage that mutual fund for you. Okay, so that's the basic explanations. A share, B share, C share. Now let's get into a little bit more detail and what may or may not be appropriate for you. So for an A share, again, this example, you have a retirement plan that you're bringing over, okay, to an IRA. Now when you want to purchase some mutual funds, and if you're looking for the A shares, it could be up to 5%. It could be a little bit more depending on what you want to purchase, could be a little bit less, but let's just say 5%. So you bring over $100,000, you buy $100,000 worth of this A share, or A shares. Okay, what's going to happen now is you're going to get your first statement. And you're going to look at your statement, and it's going to say the value of your fund is now $95,000. What happened? Well, right off the top, they're going to take $5,000 off as their commission, or what they say, they call it a front load. It's a front-loaded fund. Well, that's not good. Well, it depends. Because what happens is the mutual fund companies, the way they make their money is by these management fees, these fees that they charge you to manage the fund. Now, you're going to pay more money up front for that A share, but you pay a lower management fee going forward. So, for example, maybe your management fee might be 0.6, 0.7%. All right. Now, also, you have what's called breakpoints. So let's say you want to buy $100,000 of this particular fund, and you're going to pay the full amount, 5%. But if you buy $150,000 worth of that fund, then maybe you're going to pay 4.5%. And if you buy $500,000, maybe you're only paying 4%. So the more you buy, the less of a commission they're going to charge you. Now the other benefit of the A shares is that once you're in, now let's say you buy a large cap growth and you buy a mid cap value and a bond fund. All right, don't worry about the particular names. Let's say you buy mutual fund A, no, what do you say? Mutual fund 1, mutual fund 2, mutual fund 3. Okay, so you have 3 mutual funds all from the same company, all A shares. Now what happens is you paid your front commission, but now you want to change. Well, what's awesome is that now, as long as you stay within that same company, you can change from, say, a bond fund to a growth fund, or a growth fund to an alternative investment, or a mid-sized fund, mid-sized company, or mid-cap to a small cap. So you can change within that fund company and not pay that commission again. So it turns out that even though getting that big hit up front, that front load or commission up front, if you want to actually hold these funds and stay within this fund company for a long time, which is going to be, I'd have to say probably 6, 7, 8, 9, 10 years or more, the A share is your best bet, okay? I'm not giving you investment advice. I'm not telling you should do this. I'm just saying strictly from a mathematical perspective, all right? And when you do your own research, you'll see that as well. From a mathematical perspective of your money, long term, the A share is your best bet. Okay, well, what's the B share? Well, the B share is no front commission. So you're not going to pay a commission when you buy the B share, but they have a back-end commission if you try and sell it before 6 or 7 years. Let's just say 6 years for this example. So let's say, again, you buy $100,000 worth of this mutual fund or mutual funds, and you buy it. There's no front end, or there's no commission up front, so the first time you get your statement, it's going to say $100,000. Fantastic. But let's say 3 years from now, something happens. There's a hole in the roof, and you need to take that money out or something, so you need to sell those mutual funds in order to pay for that hole in the roof. Well, now there's going to be a back-end commission. So depending, if you sell it before that 6 or 7 years, then what happens is they give you a back-end sales charge, and that could be relatively steep. Basically, the mutual fund companies are going to get their money one way or the other. Also, remember how I told you with the A share how it's a relatively low annual sales charge that they charge you to manage the fund. With the B share, it's higher. So it's going to be higher than the A to manage it, to maintain it, and if you try and get out early, there's going to be a sales charge. Now what's also interesting is that after that 6 or 7 year period, it'll automatically convert into A shares. Very interesting, right? But basically the mutual fund company is saying between the A and B, we're going to get you either way. We're going to have you pay either up front, or we're going to have you pay with a larger annual service charge, and if you try and get it out early, we're going to give you a back-end service charge. Okay, so what we have left, we have C shares. C shares are very interesting also because there's no front-end charge for a C share either, but they're much more expensive to maintain. That means that the mutual fund manager is going to charge you much more of a management fee or an annual charge, or however makes the most sense to you. So let's say an A share is 0.6-0.7% per year to manage, okay? The C share might be 1.4, 1.5, 1.6% to manage that same share. It's significantly different. Also, you need to keep it for 1 year, okay? You need to keep your C share for 1 year. If you sell it before then, again, it's going to be deferred sales charge. So it's fascinating. Again, it's all the same basket of stuff. It just depends on how you want to pay for it and what your personal situation is. The C share, even though it's more expensive to maintain, if you're only going to have it for a short period, maybe that makes more sense for you rather than paying that big upfront sales charge. If you're going to have these shares for a long time and you like that particular company, this is really important. If you like that particular mutual fund company and you're like, hey, you know what? I can stay with this company for a really long time, then maybe the A shares are make more sense for you because you can buy them up front, lower management costs, and then you can switch in between all these different funds once you're in. B shares, if you know you're going to be in for a long time, there's no upfront sales charge, but there is a larger fee on an annual basis. So again, mutual fund companies, they're going to get their money either way. It just depends on how you want to slice it and dice it. And of course, if you try and get out early, then they are going to give you a commission to sell it. And you have to pay that. You're not getting it. You're given that to you as a deferred sales charge. Okay. Yeah, there's also no load funds. That's a completely separate video. That's also something that's very interesting and worth looking into. Basically, that's no sales charge, and they're going to give you a expense ratio that actually might be very competitive to some of the other funds that we talked about. But again, A, do your own research. B, separate video for here. So thanks for watching. Next video I'm going to do is going to be ETFs, exchange traded funds. Hope all is well. You take care.